The first qualitative measure of monetary supply is margin requirement. Now, what is margin requirement? This refers to the difference between the current value of security offered for loans and the value of the loans granted. Suppose a person mortgages an article worth 10,000 with a bank and the bank gives him a loan of 8,000. In this case, the margin requirement would be 20,000. If the flow of credit is to be restricted for certain business activities in the economy, then the margin requirement of loans is raised in those activities. And the margin requirement is lowered if the flow of credit is to be increased. So here you have arrows pointing out and telling you what the RBI will do. When the flow of credit is to be decreased, the margin requirement will be increased. And if the flow of credit is to be increased, then the margin requirement will be reduced. The second qualitative measure of monetary policy is moral suasion. Sometimes the central banks make the member banks agree through persuasion and pressure to follow its directives on the flow of credit. The member banks generally do not ignore the advice of the central banks. The banks are advised to restrict the flow of credit during inflation and to be liberal in lending during deflation. And they do this by way of informal meetings, calls to commercial banks, in many other ways. They try to persuade, or in some cases they may need to pressurize. The second qualitative measure monetary policy is rationing of credit. Now this refers to the fixation of the credit quotes for different business activities by the central bank. It is a method by which the central bank seeks to limit the maximum amount of loans and advances, and also in certain cases to fix a cap or a ceiling for specific categories of loans and advances. The fourth qualitative measure is direct action. The central bank may initiate direct action against the member banks in case they do not comply with its directives. Direct action includes derecognition of a commercial bank as a member of the country's banking system. It may also be in the form of fines and penalties and so on. Next is we are moving on to study what is credit creation by commercial banks, or how credit is created by commercial banks. Before we go there, we just need to kind of revise what are primary deposits and secondary deposits. Now, primary deposits are cash deposits with the commercial banks by the people. These are reflected as a part of demand deposits of the bank. Primary deposits points to the savings of the depositors with the bank. Having said that, let us move on to what are secondary deposits. They are those deposits which arise on account of loans by the banks to the people. These are also reflected as a part of demand deposits of the bank. Secondary deposits point to the borrowings of the depositors from the banks, and these are also known as derivative deposits. So loan deposits or loan account deposits would be secondary deposits or derivative deposits. Let's see how money or credit is created by commercial banks. Now we have a formula to derive that. And that is, total money created is equal to the initial deposits of a commercial bank or with commercial banks multiplied by 1 upon the cash reserve ratio that we spoke about earlier, which is the fraction of the total deposits that commercial banks have to maintain with the central bank. Let us consider that the CRR is 20% and the initial of fresh deposits is 1 lakh.